$1.30 per ounce. That was the price of silver in 1967. A managed price, controlled lie. 3 years later, $1.80. The system was already buckling. By January 1973, it exploded. The price was $3.27. Doubled. Gained 151%. This wasn't a sudden surge. It was a mathematical consequence. The system ran out of metal. The paper exchange, the COMEX, strained until the breaking point. It happened then. It happened again in 1980. This is the recurring systemic logic. The pattern always holds. The paper promise inevitably collides with the physical truth. Right now, the silver market is showing the exact same catastrophic stress indicators. We are watching the third major system strain unfold in real time. This isn't history repeating itself. This is a predictable economic mechanism cycling to its violent conclusion. You need to see this now. The story starts with the government. The year is 1967. The COMEX, the Commodity Exchange Incorporated, existed under the thumb of the U.S. Treasury. Back then, the dollar still claimed a connection to precious metals. The silver in your coins was supposed to be backed by Treasury reserves. But the Treasury was facing a mathematical impossibility. This is where the first strain began. The U.S. government had acted as the ultimate short seller since 1934. They were the unlimited supplier, capping the price. But by the mid-60s, that supplier was bankrupt of physical metal. The first strain, the Treasury's surrender, 1967 to 1973. The government was dumping its reserves to keep the price anchored. They failed. On July 14, 1967, the U.S. Treasury finally threw in the towel. They ceased all sales of silver at the official fixed price of $1.29 per ounce. This was a policy surrender. It was the first crack in the COMEX's control mechanism. The market was suddenly forced to find a real price. There was no Treasury cushion left. Demand did not slow down. It intensified. Industrial users and investors realized the scarcity was real. By 1970, the COMEX registered inventories, the metal officially designated for delivery, had dropped to dangerously low levels. This exposed the core systemic flaw. A massive pyramid of paper contracts was built upon a vanishing base of physical metal. This is the definition of engineered fragility. The stress became overwhelming. Traders, manufacturers, and large investors began demanding physical delivery. They understood the difference between paper and metal. They didn't want the contract. They wanted the ounces. This physical drain on the system reached a point of no return. The COMEX was scrambling throughout 1971 and 1972. The failure was visible in the shrinking vaults. Then, the inevitable mathematical consequence arrived. By January 1973, silver crossed that $3.27 per ounce mark. The price simply reflected the exhaustion of government supply. Shock number 1. The U.S. Treasury's foundational silver stocks plummeted from over 2 billion ounces in 1959 to virtually nothing by the end of 1970. This physical depletion was the undeniable engine of the first price doubling. The systemic logic proved unbreakable. Zero metal equals zero control. The system strained, broke, and the price corrected violently. The underlying supply failure was the cause. The price change was just the effect. But the people running the exchanges do not learn. They only work to make the control mechanism more subtle. The second strain, the Hunt brothers and the regulatory panic, 1979 to 1980. The 1970s brought monetary chaos. Fiat money was exploding. Inflation was destroying the value of paper currencies. This environment was perfect for the systemic logic of physical assets. The COMEX, having survived the 1973 break, had only grown more arrogant in its paper leverage. This arrogance was about to be punished. The mechanism was exposed by the Hunt brothers. They understood the simple truth. When the paper price is held artificially low, far below genuine industrial and investment demand, the metal is undervalued. They started buying physical silver and demanding delivery on their futures contracts. They were simply forcing the COMEX to honor its paper promises. The critical phase began in 1979. As the hunts accumulated, the COMEX registered inventories began to fall sharply again. The exchange watched its physical backing disappear in real time. The ratio of paper claims to available physical silver became unsustainable. This created an immense, existential counterparty risk for the entire exchange. The strain peaked in early 1980. The price of silver hit its extreme high, briefly touching near $50 per ounce. This was a massive move, but the doubling from the 1978 low of $5 per ounce to $10 per ounce had already happened much earlier, proving the systemic pressure was already building. The real problem was the paper leverage. Shock number 2. As the crisis mounted, the net short position of the largest traders on the COMEX, the entities obligated to deliver metal, reportedly soared to over 100 million ounces. This towering paper short position proved the market was structurally designed for suppression. The collapse was mathematically necessary. The COMEX did not tolerate the free market. It intervened with force. On March 27, 1980, the exchange announced the infamous Rule 7. This was an emergency regulatory measure. It restricted all silver trading to liquidation only. You were allowed to sell your contracts. You were explicitly forbidden from buying new ones. This was a transparent, panicked manipulation. It was designed to relieve the systemic stress on the large short sellers who were facing delivery default. The price immediately collapsed. The exchange survived, but the pattern of fragility was confirmed. When physical reality challenges paper control, the powerful change the rules to protect themselves. The systemic lesson from the first two strains is brutally clear. The COMEX system is not a true price discovery mechanism. It is a control and management tool for price stability. When physical pressure mounts, the exchange either runs out of metal or resorts to regulatory panic to save its largest players. This pattern never fails. We are now deep into the third iteration of this pattern. The systemic logic is identical, but the execution of control is far more refined and quiet. This new fragility is not accidental. It is engineered. This time, the stress is not a single government or a single accumulator. The stress is a quiet, powerful, and persistent industrial drain. This is the consequence of the so-called green transition. Solar panels, electric vehicles, and high-tech electronics demand vast quantities of silver. Meanwhile, new mining supply has been utterly neglected for decades. The world now consumes more silver every single year than it can dig up. This structural deficit is the ultimate fuel for the coming crisis. The COMEX, now part of the powerful CME group, has learned its lesson. They hide the vulnerability through a clever tiered inventory system. You must ignore the surface numbers. You must look at the two critical categories of their vault holdings: registered and eligible. Eligible inventory. This is metal physically present in the vault, but it is not designated for settling futures contracts. It sits outside the immediate delivery mechanism. Registered inventory. This is the only metal the exchange truly guarantees to deliver against a futures contract. This is the exchange's true liquid, ready supply. The current extreme systemic fragility is found only in the registered stock. In the 2020s, COMEX registered inventories have been in a relentless, sharp decline. The total amount of exchange-guaranteed silver is degrading rapidly. The exchange's ability to actually settle paper claims with physical metal is collapsing. Shock number 3. COMEX registered silver inventory has fallen from a robust peak near 150 million ounces in 2021 to a precarious level below 30 million ounces recently. This catastrophic decline of over 80% represents a profound and escalating systemic risk. This is the modern, refined equivalent of the Treasury running completely out of physical metal in 1967. The critical shelf is now essentially empty. This dangerously low registered number is explosive when compared to the paper market. The open interest, the number of paper contracts outstanding, often represents claims on hundreds of millions of ounces. When you calculate the ratio of paper claims versus the readily available registered ounces, the fractional reserve system is exposed as extreme and unsustainable. This is the recurring mechanism in a new disguise. Most people trade the paper proxy. This creates an illusion of liquidity. This liquidity benefits the concentrated short sellers, the large banks and institutions who keep the price contained. But the physical world ignores paper. The industrial demand is a force of nature. This systemic pressure is silently building beneath the market surface. Shock number 4. The annual global silver mining supply has remained stagnant, hovering near 820 million ounces in recent years. In contrast, total demand has accelerated. For the last 3 consecutive years, the physical market has been running a massive structural deficit. More silver is consumed than produced. This is a fundamental mathematical pattern. No paper exchange, no matter how powerful, can suppress this reality indefinitely. The system is consuming its own irreplaceable assets. The modern refinement is the financial engineering. It allows the short position to be maintained slightly longer without immediate default. But the core logic remains absolutely the same. A concentrated paper promise will always fail when confronted by a distributed, absolute physical reality. The COMEX is straining. This structural failure should be the single thing that makes you lose sleep. The pattern is complete. The structural supply deficit is locked in for years to come. The COMEX registered inventory has been fatally depleted. The third time the COMEX strains before a major price break is not a random event. It is the systemic logic completing its predictable cycle. When this current strain finally breaks, the price increase will not be gradual. It will be violent, chaotic, and instantaneous. The mechanism of the final collapse is the realization of systemic counterparty risk. When a relatively small portion of paper contract holders simultaneously demand physical delivery, the registered vaults will be emptied in a matter of days. The exchange will face the exact impossible choice it faced in 1980. They will be forced to either deliver metal they absolutely do not possess, or they will panic and change the rules of the game again. The consequence will be an immediate, massive price dislocation. The system will suddenly fail to provide the most essential industrial commodity needed for the 21st century economy. The cost of every solar panel, every piece of critical electronics, and every electric vehicle will be instantaneously repriced to a shattering new level. This financial event will expose the deep, unavoidable rot of the entire fractional reserve commodity trading system. It will be the final proof that financial promises, when excessively leveraged against a necessary and finite physical resource, are utterly meaningless. The fallout will be a profound loss of faith. Market participants will finally realize the price they see on the screen is a regulated fiction. It is a policy tool, not an accurate reflection of supply and demand. The physical market will permanently decouple from the paper market, creating a devastating bifurcated system. Silver will not just double. It will reprice to reflect its true scarcity and critical industrial necessity. Shock number 5. The gold/silver ratio, the core measure of relative metal scarcity, has historically maintained a ratio closer to 16:1, based on known geological abundance. Today, the ratio sits near 85:1. This historically extreme deviation is the clearest single piece of evidence. The price is structurally, mathematically suppressed. It is waiting for the inevitable violent correction. When this systemic logic is allowed to complete its run, the price will find its true level. This level will reflect the years of global consumption deficit and the near-zero remaining registered supply. It will be a violent correction of value. This is the consequence of prioritizing financialization over physical reality for decades. This is the final warning. This video explains historical and economic systems. It is informational, not financial advice or price forecasting. The COMEX strained in the late 60s, and the price doubled. It strained again in the late 70s, and the price absolutely soared. It is straining now for the third time. The underlying mechanism is completely identical. A concentrated paper short is now exposed to a decentralized, relentless physical drain. The systemic logic always prevails. The collapse of the paper pyramid is not a question of if, but a certainty of when the final physical contract holder demands their ounces. Do not wait for the inevitable moment of panic. Understand the recurring mechanism. Study the data. Prepare for the consequence. To get the full, detailed historical breakdown of the financial engineering that allows this systemic fraud to continue, hit the subscribe button now. We reveal the cold, hard logic of collapse every single week. Join the membership to access our exclusive deeper dives into the critical commodity reserve data. The promise is political. The consequence is mathematical. No one escapes.